What if I told you that the single most reliable way to turn geopolitical chaos into personal fortune has repeated like clockwork for centuries? Every major war triggers massive government money printing, which sparks runaway inflation and destroys trust in paper currency. So the smart money flees straight into gold, the only asset that has survived every fiat collapse for 5,000 years and quietly creates a new class of millionaires while everyone else pays the bill through higher prices and eroded savings. Yeah, you heard that right. Wars do not just destroy countries, they create the ultimate wealth transfer mechanism hidden in plain sight. And right now, in March 2026, with the Iran conflict driving oil prices higher and inflation fears spiking, we are watching the exact same pattern unfold again. If you think gold is just a shiny relic for conspiracy theorists, or that your retirement account stays safe when governments crank the printing presses, then buckle up. Because today we are ripping open the gold rush after every war. The sarcastic truth about how smart capital has beaten paper money for millennia, the documented explosions in gold prices after World War II, the Vietnam War, and the 2003 Iraq invasion, and the way the current Iran war is already handing billions to those who understand the cycle, while the rest of us get distracted by headlines. Stick with me until the very last word, because the verified historical data, the mechanics of money printing, the real-time moves by central banks and hedge funds, and the brutal lesson that wars do not just end in treaties, they end in new millionaires, will leave you equal parts furious and empowered. If you are ready to stop being on the losing side of history and start seeing the hidden money moves that rich people never talk about, hit that subscribe button right now, turn on notifications, so you never miss these deep dives, and drop a comment below telling me whether you own any gold right now, or if this pattern has you thinking about it for the first time. I read every single comment, and we are building this conversation together as a community that demands the real financial truth. Welcome to Money's Hidden Past. Rich people lied, we fact-checked. Let us start with the timeless mechanism, because once you see how wars and gold have danced together for centuries, the current chaos in the Middle East stops looking like random headlines and starts looking like the oldest profit playbook in the book. Every major war forces governments to spend far beyond their tax revenue, so they print enormous amounts of money to finance tanks, planes, and soldiers. This flood of new currency creates inflation, which erodes the purchasing power of paper money and destroys public trust in the system. At that exact moment, smart capital flees into gold, the one asset that cannot be printed, cannot be debased, and has served as money for 5,000 years across every empire and every collapse. The pattern is ironclad. War starts, massive money printing, inflation rises, currencies weaken, and gold explodes in value. Governments promise the inflation is temporary. Smart investors know better, and the wealth transfer begins. The ones who rotate into gold early ride the wave to new fortunes. The ones who stay in cash or bonds watch their savings melt away. This is not theory. This is financial history repeating with mechanical precision, and the current Iran conflict is delivering the latest live demonstration. The first modern masterclass came after World War II, when Europe lay in ruins, and the United States emerged as the only intact industrial power. Governments on both sides had printed money at unprecedented scale to fund the fighting. By 1945, the world was drowning in paper currency, with trust in fiat at rock bottom. Gold, which had been fixed at $35 per ounce under the pre-war gold standard, came under enormous pressure. The Bretton Woods system tried to hold the line by pegging the dollar to gold and other currencies to the dollar, but the damage was done. Inflation pressures built throughout the 1950s and 60s as war debts lingered and reconstruction costs mounted. Then came the breaking point. In 1971, President Richard Nixon slammed the gold window shut, ending the last link between the dollar and gold. That single decision unleashed the greatest gold rally the modern world had seen. From the fixed $35 per ounce gold began its unstoppable climb. By 1980, it had reached $850 per ounce, a 24-fold increase in less than a decade. Investors who rotated into gold during the late 1960s and early 1970s turned modest holdings into life-changing wealth, while those who trusted paper currencies watched their savings evaporate in the great inflation of the 1970s. The sarcastic truth here is that World War II did not end in 1945. Its financial aftershocks created the first great post-war gold rush and rewarded the patient few who understood that governments always print when the bombs fall. The pattern repeated with textbook precision after the Vietnam War. The United States poured hundreds of billions into the conflict in today's dollars, while simultaneously funding the Great Society domestic programs. The Federal Reserve accommodated the spending by expanding the money supply dramatically. Inflation, which had been tame for decades, suddenly roared to life, reaching double digits by the late 1970s. The dollar weakened against every major currency, and trust in American paper money collapsed. Gold, which had been artificially capped at $35 per ounce, until the 1971 Nixon shock broke free and began its legendary ascent. From the early 1970s, low of $35, gold climbed steadily, then explosively reaching $185 by 1975, $400 by 1979, and the famous peak of $850 in January 1980. That was a 24 times increase in just 9 years. Investors who bought gold during the height of Vietnam spending and held through the chaos turned every $10,000 into $240,000, while the average American family struggled with 19% interest rates and gas lines. The lesson was unmistakable: war spending plus money printing equals gold profits, and the 1970s delivered the proof on a silver platter, or more accurately, on a gold bar. Fast forward to the 2003 Iraq War, and the same cycle played out again, only faster and with even bigger numbers. The United States launched the invasion amid massive deficit spending that added trillions to the national debt over the following decade. The Federal Reserve responded with ultra-loose monetary policy and later quantitative easing after the 2008 financial crisis, which was itself partly fueled by war-related economic distortions. Inflation fears returned gold, which had been trading around $300 per ounce in 2003, began its epic climb. By 2008, it had doubled to over $600. By 2011, it hit $1,900 per ounce, a more than six-fold increase in 8 years. Investors who rotated into gold exchange, traded funds, and physical bullion during the early Iraq years captured gains that turned ordinary portfolios into seven-figure nest eggs. Meanwhile, the dollar lost purchasing power, oil prices spiked, and everyday expenses rose. The sarcastic punchline is that while politicians promised quick victories and low costs, the real winners were the gold holders who understood that war always ends with more paper money and less trust in it. The 2003 Iraq War proved the pattern was not ancient history. It was still very much alive in the 21st century. Now here we are in March 2026, watching the exact same movie unfold in real time with the Iran conflict. The United States military operation has already burned through tens of billions in the first weeks, with projections reaching $184 billion by September. Oil prices have spiked more than 10% in days because of disruptions in the Strait of Hormuz and the Bahrain refinery strike. Governments are once again opening the spending taps, and central banks are already signaling they will accommodate the fiscal surge. Inflation expectations are rising again, and the dollar is showing early signs of weakness against hard assets. Gold, which had been trading in the $2,300 range before the escalation, has already begun its familiar upward march, with daily gains accelerating as smart money rotates in. Hedge funds and institutional investors are increasing their gold allocations at the fastest pace in years, according to Commodity Futures Trading Commission data. Central banks, particularly in Asia and the Middle East, are adding physical gold to their reserves at record rates because they remember what happens when paper currencies face wartime pressure. The pattern is identical. War starts, massive money printing, inflation rises, currencies weaken, and gold explodes. The only difference this time is the speed of information and the ease of buying gold through exchange-traded funds, physical dealers, and even cryptocurrency-backed tokens. The smart money is already positioned, while retail investors remain distracted by the latest missile headlines. The energetic reality that makes this cycle so predictable is the simple mathematics of fiat currency. Governments cannot tax their way out of war spending, so they borrow and print. The extra money chases the same amount of goods and services, driving prices higher. People lose faith in the currency and seek the one asset that cannot be created at will. Gold has no central bank issuer, no printing press, and no government promise attached to it. That is why it has outlived every empire, every currency collapse, and every war for 5,000 years, from ancient Rome to Weimar Germany to modern Zimbabwe. When trust evaporates, gold becomes the default safe haven, and its price reflects that flight to safety. The current Iran conflict is providing fresh fuel exactly as the previous wars did. Oil spikes feed inflation fears, which feed money printing fears, which feed gold buying. Each new strike or retaliation adds another layer of uncertainty and another reason for capital to seek shelter in the yellow metal. The broader lesson is as cold and reliable as it is profitable. Wars do not just destroy countries, they create new millionaires through the gold mechanism. The ones who understand the cycle rotate early and ride the wave to generational wealth. The ones who do not stay in cash bonds or traditional savings accounts pay the hidden bill through inflation and currency debasement. This is the real wealth transfer mechanism hidden in plain sight. Governments print the rich buy gold, and the middle class absorbs the cost. It has happened after every major conflict for centuries, and it is happening again right now. The difference today is that you have the information and the tools to join the right side of the trade, instead of funding it unknowingly through your tax dollars and eroded purchasing power. From the money printing of World War II that launched the first modern gold rush to the 1970s explosion after Vietnam to the 2011 peak after the Iraq War, the pattern has never failed. And with the Iran conflict already driving oil prices and inflation expectations higher, the gold rush of 2026 is already underway. Central banks are buying hedge funds or positioning, and physical demand is surging. The smart money is quietly accumulating while the headlines keep the masses distracted. The question is, which side of the transfer will you be on when the dust settles? History has already written the script. The only variable left is whether you act on it. If this deep dive into the gold rush after every war and how the current Iran conflict is repeating the exact same wealth transfer pattern fired you up about protecting your money from the hidden costs of conflict, then do me a favor right now. Smash that like button to let the algorithm know this conversation matters. Share this video with every friend and family member who needs to understand how wars really create fortunes, and let us keep exposing what they do not want you to see. I will catch you in the next one, where we break down the next chapter in this timeless cycle. Until then, stay informed, stay skeptical, and remember that when governments print gold, listens, and the ones who listen first get rich.